What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Annie, Will and Ben here with you, giving you the latest in what's been happening on the news. I'm back from my hiatus. I popped away over to Europe for a couple of weeks, so you guys manned the fort for us over the last few weeks. How has it been? What's sort of the goss? What's the news? What's the dramas that's been happening on the advisors since I've been gone? Ben?
There's been plenty of things happening. I'm just relieved I don't have to host. But yeah, it's good to have you back. And yeah, this was actually a massive week in terms of news. So
huge week, I know. I felt like I came back and it was a bit like, right, loads of news flashes happening. Maybe everyone just very kindly waited while I was away on holiday
yeah,
to do
their
big news.
Yeah.
Although we did have some big announcements while I was away. So the broker market share new record was one that I saw, which I was like, interesting. And then a couple of other things that we sort of saw generally, I think, in the market about lenders changing things. So really great to see you guys, you know, obviously taking on the news and the podcast, and you both did a great job. Will, for you, what was the big sort of highlights over October?
It seems like ages ago.
Yeah.
I mean, that broker market share was big. I guess we're kind of expecting it, but
Yeah.
Interesting to see. I mean, more results from lenders and stuff. That
Yeah,
was
well, this
interesting.
week has been results season.
Yep.
Again, always comes around faster than we'd like it to. 'Cause
Yeah.
it's a bit of an undertaking when we have to all of the lenders, because they have slightly different calendars as well, reporting different things. Results season's always super busy for us. And I think, of course, with things like either full year results or half year results, some are quarterly results, everyone's got slightly different calendars. So we've been seeing a lot of the banks announce this week what they've been up to. We'll get into that a little bit later. But first up, the race that stopped the nation on Tuesday didn't stop us because it was cash rate decision day, of course. So unfortunately for finance journos across Australia, we don't get to have any fun on Melbourne Cup Day because we get to actually cover the news, see what Michelle Bullock and the RBA are doing on cash rate decisions. This week, I think pretty much everyone was expecting them to hold, which they did. But some of the fallout from it, I thought, was pretty interesting. Now, Will, you've been covering a lot of the inflation data for us. You were covering the rate decision as well on Tuesday. What is the lowdown?
Yeah, essentially, I'd say the announcement itself, as you said, was fairly ordinary. Unanimous decision, hold 3.6%, which everyone predicted. The interesting bit was they revised their inflation forecast. So RBA, this is obviously quarterly inflation came in higher than expected.
Yeah, you talked about that last week, I think.
Yep. And then, so the underlying inflation forecast, they've essentially changed. So they're now forecasting it to keep going up to 3.2% for next year. For December quarter. And then next year, it'll stay that level. And then it won't start going down again to the second half of 2026. So it's quite a sizable increase.
Yeah. And I think because, again, like no one really on a Tuesday afternoon on Melbourne Cup Day is pouring through the Statement of Monetary Policy the same way that we are. It's like a 60-page document where they revise our forecasts. But looking through it, and I think there's a table in there that showed their inflationary forecast figures, and they had previously said inflation being around 2.7, 2.8 for most of 2026, and now it's 3 point something pretty much the whole way through the year, as you said.
Yeah.
But they're not getting into target range until 2027.
Yeah.
So that's a long way out. And lots of people were then being like, so does that mean we're not going to get a cut then until that time? Like, what's going to happen? And Michelle Bullock was pretty obviously, again, not wanting to give forward guidance, but pretty more hesitant, I think, than we've seen recently around whether or not there'd be another cut.
Yeah.
What did you- is
she
that what you
explicitly
thought?
said anything's possible.
Anything's
she said,
possible. I mean, she
yeah,
hedged,
go
though.
down.
She's like, it could be possible that there are no more cuts.
Yeah.
It could be possible that there are. So she kind of still hedged. But I think what's interesting to me is, we'd already seen lots of the banks change their rate forecasts and their trajectories based on the quarterly inflation figure. But even following her press conference where she was quite hesitant, people have now been like, this is probably the end. Do you guys think that? Do you think we'll have any more rate cuts?
It's hard to say. I think you can sort of see, when you look at that chart as well, you can sort of understand the RBA's thinking and understand how economists are sort of viewing that to play out over the next few years. But I guess, it always evolves with more data coming in. So
yeah, and of course inflation's not the only thing they're looking at. They're still always looking at employment. They're looking at spending as well. She also called out in the inflation figures specifically, the housing costs, so the cost to build at the moment. And she specifically sort of said, if you're trying to build, it's impossible to find a builder. So I think this is something that we're really seeing a lot at the moment. It's this massive demand at the moment for supply, but also for people trying to renovate. Lots of building work going on, which is sort of pushing into the costs for inflation. But yeah, I thought that was really interesting what she was saying around anything's possible. We just don't know.
Yeah, well, she did say the technical assumption that the RBA used is still for one more cut next year. And then I thought the press conference, she gave way more away than she normally does.
Yeah.
And then there was a question on their inflationary midpoint target, so 2.5%.
Yeah.
If they've changed their assumption so their forecast is 3.2%, it's way higher.
Yeah.
And someone said, are you still even looking at the midpoint? That's so far off.
Yeah.
And they said, yeah, we are, but it's going to be a while.
Depends on everything else.
Yeah, exactly. So
I think the other thing that was fairly interesting as well was looking at, what does that mean for... I completely forgot what I was going to say. Something was interesting. Can't remember what it was.
House prices? What does that mean for house prices?
No, but that is the next thing we were going to talk about. It was something about what she was saying.
employment? Maybe.
I know. I think also what's interesting is following the press conference, lots of people suggesting maybe the next movement will be a hike. So this is something we haven't talked about for a while. Everyone was kind of assuming that the rate easing cycle would continue until mid-2026. And I think most people still sort of say around May 2026 will be the next cut. So yeah, but now people are being like, well, if inflation is higher than it should be, and if things aren't going the way, if people are spending a lot more, and if unemployment is still pretty low, maybe we should be looking at hiking. Do you reckon that's feasible? Do you reckon the next 12 months we'll have a hike?
She didn't rule it out, to be fair, when she was asked. Possible. I think it would be in the second half of 2026. But hypothetically, if unemployment keeps going up like it is, inflation keeps going up like it is, and then demand is gradually softening,
a cut would be more likely.
Yeah. Well, it's so hard to call, isn't it? I guess. But I wouldn't rule it out. I think if the RBA haven't ruled it out, then it's not impossible next year.
The funny thing is, as always with the RBA's assumptions as well, is that they have to feed in to their forecasts what the market thinks that they're doing. It's like this really stupid circle where they're like, the market thinks there's going to be another cut, so we have to base our forecast based on what the market thinks we're going to do.
Yeah,
and then
it's like an interpretation of an interpretation.
Exactly. It's just like it goes around and around in circles. So I think a lot of people were really hung up on that in the statement of monetary policy, being like, there's definitely going to be one rate cut. And she was like, that's not what she was saying. She was saying the market thinks there'll be one more rate cut, and therefore we have to feed that into our forecast. So yeah, they're all looking at each other and pointing at each other. Anyway, but because of all this chatter around what's happening with the rate trajectory and this easing cycle, lots of people kind of looking at, well, maybe I'll get into market now, because if there is going to be a hike, I don't want to hang around and wait. And of course, it's spring anyway, so the property market is super busy. Everyone's wrapped up in property fever. Plus, we've had the expanded home guarantee scheme start, and we had some initial figures come out from Treasury this week that, Will, you were chatting to them about. What do we know so far?
Yep, so obviously started October 1st, and then we've got the first round of data just on uptake, essentially. So this is from Treasury, and they've said around 6,000 first-home buyer guarantees were issued last month. So that's up almost 50% on the previous year, before, obviously, the scheme was expanded. Really interesting, I thought, kind of what was there, but what also wasn't there in terms of the data. So they've specifically said there's been a lot of kind of criticism around price impacts and kind of it making it easier for first-home buyers, which increases demand, which increases prices. They've claimed that, so this is Treasury, that the expanded scheme will have a 0.6% impact on house prices after 6 years. And we did ask the modelling for that, and we got nothing.
Yeah.
And actually, Housing Australia specifically said that's not our modelling, that's from Treasury.
Treasury, yeah.
So really interesting. I think essentially the takeaway, uptake's been really strong, and brokers have said the same thing. There's loads of requests.
Yeah.
And then in terms of the price, it's hard to judge what it's done to price.
Yeah, we tried to figure out what proportion that meant of first home buyers, but we don't actually have ABS figures yet
Yeah.
for October. That doesn't come out for ages, for a couple more months. So we actually can't really see. We were trying to extrapolate out to be like, well, what is 6,000 home buyer guarantees based on the whole market?
Yeah.
But I think if we look, so we were looking at June quarter figures,
Yeah.
and we were thinking it's probably about 20% of the market is first home buyers. And this is probably what, like 5-10% of first home buyers then?
Maybe like 10.
10.
But it's really hard to. I think we will get that number.
Yeah.
But at the moment, it's.
We try and do the maths for
Yeah,
you.
yeah.
It was pretty hard. I couldn't find data that would actually
Yeah.
accurately reflect it. That's whole of market. So it's still a lot. Like I think it was
Oh, yeah.
48% higher than in October 2024.
Yeah.
Yeah.
So it's a big jump.
A big jump.
Yeah,
And I was having a look again at the information packs because they no longer call it the home guarantee scheme. It's now called the 5% deposit scheme.
Yeah.
Does what it says on the tin. They've actually changed all the names of them.
Yeah.
They didn't really even tell people they were doing that. They just started calling it something
Yeah,
different.
just one day.
And I was like, what
Yeah.
is this? So the 5% deposit scheme, I was reading some of the documentation on it, and they do have this little warning, which I think was pretty interesting, being like, we want to make sure that the right people are using this and that people aren't trying to circumnavigate using cash savings that they actually have to access this scheme. So they were like, we won't accept people who've like transferred money to another person to look like they don't have genuine savings of 20% in order to qualify for this scheme. They're like, don't cheat the system,
Yeah.
people. Which I thought that was pretty interesting. It's the first time I've seen that explicitly written in the documentation. So that was really interesting. But of course, yeah, house prices being this major focus at the moment because we've seen already some stats from both PropTrack and Cotality saying another massive increase in house prices for October. Probably this didn't help the home guarantee scheme. Sorry, the 5% deposit scheme.
Yeah.
Plus, the spring selling season, plus rates have been going down. So it's been a whole sort of load of different things that have been feeding into prices. And now, again, another record high, another increase. I think we're already at 6% house price growth this year. And most people had forecast that to be by December we'd be there. So looks like it'll be a big year for house price growth again this year. Not so great if you're trying to get into market, but great if you're already in market.
Yeah.
Essentially.
We talked briefly earlier about the results from the major banks and other banks, and we'll get into that just after this break. So this week we've had financial reporting season from a few of the lenders releasing their full year results, some their half year results, and Westpac was one that we paid close attention to this week because they were kind of announcing a new strategy. Now, Will, you covered this for us. What's the go?
So I'd say the big takeaway from their results, they've explicitly said that they want to grow proprietary lending. I mean, they've kind of hinted at it before, but it's the first time they've just outright said it. And there was quite a lot of information in their results. So they specifically said they want to balance growth and return in mortgage lending, target higher returns. I mean, loads of detail around investment specifically. So they are investing in an extra 180 home finance managers. They're launching a Book a Banker program specifically for broking early next year. Just generally investing to grow proprietary lending.
Yeah, and this is because actually I think they have the smallest prop lending of any of the major banks.
Yeah.
So CBA, as we know, has been focused on proprietary for the last few years, and we've really seen that increase. I think they are speeding ahead. More than half of their flows come from proprietary channel. Most of the others are probably around 45%ish, but Westpac, proprietary channel, originated less than a third of new home loans over the year FY25. So they're really, I think, looking at, do we really want 60% coming from broker? Which, of course, brokers love Westpac. They love St. George. They love their subsidiaries. So I think kind of seeing the amount of weight they have there from a risk perspective, they're like, we want to actually balance this out a little bit. They haven't said balance, so we don't know how much they're actually targeting in their flows. But definitely, yeah, they're looking at focusing more on proprietary. So really, I guess, joining the other big four banks in doing that.
Yeah, exactly. And I guess, as you said, so their proprietary share actually went down in the last 6 months.
Yeah.
But you'd think there'd be a time lag and that will keep climbing for the next year.
Yeah, so they said they were going to try and improve proprietary by hiring more bankers,
Yep.
by doing this new service that I think other banks have where you can book a banker. So if you want to talk to someone about a home loan, you can book in them automatically. And then they're also investing in their brand, so expecting more marketing, probably more promotions around proprietary moves. So really interesting to see that. And I think, again, like looking at what's been happening generally, this is a similar trend across the board for not just majors, but for a lot of banks, looking at focusing on the proprietary, focusing on digital spend, focusing on people and being like, we want to try and bring in a bit more proprietary lending because it has higher margin. So according to some of the lenders, that can be around 20 to 30%. I think that's what NAB was saying this week. When they announced their results, they suggested that direct was 20 to 30% higher margin than broker. And I think generally, you know, they're kind of being like, we just want to claw back a little bit more control. So it'll be interesting to see what brokers do off the back of this, if they actually start, you know, if they do stop sort of sending loans to Westpac, or if they start broadening out their people that they're using. Yeah, very, very interesting from Westpac. And the other thing that was interesting, I think, this week, and you mentioned it last week, was the RAM sale.
Yeah.
So we wrote a story last week saying that Pepper Money was in a consortium of people who was looking at buying the Rams portfolio, and that actually was completed, or at least, finalised this week. So we heard when they were announcing their results that this had been confirmed. So $21.4 billion portfolio from Rams will go to a consortium that includes Pepper Money and global investment firm KKR and investment manager PIMCO. So this basically is mostly, I think, looking after the book because, as we know, Rams stopped taking new business last year, I think it was, following a range of compliance issues and court cases around compliance and fraud. So I think this is basically not, from I understand at least, not trying to revive it, just buying the book. So yeah, that'll be interesting to see. And I think completion's obviously going to go through the normal approvals. It's expected to occur in the third quarter of 2026. So that's a nice little bow around, tying the bow around that sort of story that we've been following for a while. I think elsewhere we've been seeing other banks also announce similar things. So NAB was yesterday. I covered that one early in the morning and was on the call with media with the CEO, Andrew Irvine, and they were talking about what they've been seeing. And we know already NAB had announced a new focus on proprietary last year. Oh, sorry, for the financial year 25. Yeah, 25. And they were really looking at how has that sort of focus been feeding into their flows. And Andrew Irvine said something that I thought was so interesting, which is proprietary lending has grown 46% in the last 2 years. So basically, since they kind of started this, their flows have increased 46% when it comes to proprietary. So it went up from, it was 13.3 billion of new mortgages in September 24. By September 2025, that had grown to 19.5 billion. So obviously a lot of this focus, which includes, similarly to Westpac, hiring new home loan bankers, putting in new tech to allow people to actually book into banks, really paying off. So again, seeing proprietary flows increasing, broker flows decreasing, though of course broker still makes up the majority of its new flows. I think, obviously that makes it, 50%? Let me just double check that figure. Hang on.
Yeah, they said 59% of all new business came from brokers. Is that right? Which was actually a decline on the previous year.
A decline, yeah. So it's
still
nearly
the
always
majority.
been, for the last few years, it's always nearly been 60-something%. So dropping back under that milestone, pretty interesting. And I wonder how much further that will fall. We did actually ask NAB, do you have a target of like what you want flows to be? And Andrew Brown, who's the executive broker distribution, responded saying, we don't set targets like that. We want both channels to be doing well. And we're basically investing in both channels as well. So he was sort of saying, we're really looking at things that we can do to make brokers' lives easier and faster, including, leveraging AI solutions. We're working on changing credit policies. They've done a few tweaks this year and generally been like, this has been a great year for us, and we're still keen to work with brokers. So making sure to be like, this isn't at the cost of broker. We're not like, we're still focused on expanding this area and investing in this area, but
It's a tricky one because I think, the brokers are bringing, broker market share is so high at the moment, and brokers would be bringing in so much business for these lenders, but their proprietary channels are the most profitable ones. So getting that balance right and fine-tuning the messaging must be a challenge.
Yeah. So that was a pretty interesting one. I also thought what was hidden in those figures, they don't talk about it a lot, but Eubank really grown a lot of its home loan portfolio. So it's been kind of one of those quiet brands. It used to be 86400, obviously, and joined in under the UBank brand for broker. And its home loan lending increased 22% over the year. So it went from 13.4 billion to 16.4 billion, which I thought was a story they hadn't really talked about in any of the investor meetings or the media briefings. So I was like, that's really interesting. Just wanted to call that one back for you guys. But I think aside from that, we've seen a couple of more results come out. Macquarie came out this morning with their half-year results. So that ends September 2025. Again, we know Macquarie growing rapidly and still majority originated through broker channel. And they were pretty much saying, things that they're kind of really driving their rapid growth is things like their technology spend. They've invested a huge amount of money in their tech to try and ensure that home loans get approved super quickly. I think they're around 2 days. And I think then also like brokers just knowing what they're getting from Macquarie, they kind of can say, yes, we can immediately know when it's a Macquarie loan if it needs to move really quickly. Having said that, though, of course, Macquarie having changed some of its product portfolios this week by removing lending to companies and trusts. So from this month, pretty much, you can no longer apply for a loan with Macquarie if you want to borrow company and trust. So interesting move, and we unpacked a lot of that on our sister title Broker Daily last week. I think the other thing we've been seeing, as we mentioned earlier, CBA been the leader really of the major banks in terms of focusing on proprietary, and they released some stats this week that caught my eye. Ben, what did they say?
Yeah, so CBA reported a 5-fold increase in online home loan applications in September 25 compared to the previous year, with first home buyer applications increasing 4-fold and experienced borrowers applications up 6-fold, which is massive. Yeah, I think, CBA said the growth reflects a trend towards self-service digital mortgage options with customers across all age groups, but particularly 21 to 40-year-olds, sort of increasingly comfortable with doing the researching, checking borrowing capacity and all those sorts of little
using
things.
The tools they have. And I think this, again, we know CBA's put a lot of money into its tech offering and people use the app a lot. So having this kind of, as it's called, self-serve digital option, increasing in popularity is interesting. And I think this is really, again, what they want to see. We know that they announced last year a special offer for their Digi Home Loans offering, which was, it's the cheapest variable rate you can actually access through the group is through Digi Home Loans, and you have to do that obviously yourself online. So they're really pushing that and wanting people to do it themselves, to use either digital or go into branch and do it through proprietary. I thought that was pretty interesting as well, seeing the increasing uptake and wondering whether consumers will actually continue to grow. I think these figures, though, are slightly skewed because while, yes, it sounds like that's a lot, a 5-fold increase, a 4-fold increase, I think that just means because digital home loans really only properly launched last year. So you used to be able to use it for refi, and then it launched for new home loans as well. So I think it's kind of from a low base.
Yeah, absolutely.
So it sounds like a lot, but I'm like, but it's still worth following and still worth us kind of like seeing what else is happening and whether consumer appetite for digital lending and for self-serve lending does increase, because of course that's a major threat for brokers. We're going to take a quick break here. When we come back, we'll quickly wrap up what the big ASIC report into private markets unpacked this week and much more just after this break. So I feel like we've been talking nonstop here at The Advisor about private lending, private lenders, particularly the last year where we've had a much higher regulatory focus on this section of the market. Ben, I know you've been talking to a bunch of private lenders recently, both for the podcasts on The Advisor, but also for the magazine. What have been your sort of takeaways of what's happening in the private lending market?
Well, everyone was kind of, everyone knew the report was coming and was kind of just waiting for it to drop. But I think I guess a big theme is it's a rapidly growing market, and in many ways it's a rapidly maturing market. But there's definitely more scrutiny coming, I would say, from the regulator, and that's kind of what we saw with the report this week.
Yeah. So this was we know for the last couple of last year, ASIC's been doing a sort of focus on not just private credit, but generally private funds and what they're doing. And a lot of the concerns were released in the report that they actually commissioned from two academics around trying to value what size the lending market was and what's been going on. And I think most of the issues they've kind of been finding have been things like not having very transparent fees or charging fees when they really shouldn't be. But also looking at things like not having adequate governance and supervision in place, sometimes having people doing too many things, the conflict of interest concerns. So really this whole big report came out and they were basically saying private credit has its place and it can work well when done well. But at the moment we think there's room for improvement. So basically they've said we're not yet going to start regulating this area, but we want everyone to lift their standards. And here's how we want them to do that. And they've set out a roadmap for people to follow. And they're like, but if they don't, we will step in and we will regulate. So I think the main things that they're kind of saying in terms of what they want people to is make sure that they're actively overseeing fund operations. Valuations was a big one they called out, being like, we need to have much more clarity on how you're valuing things. They want to also ensure there's adequate staffing and staffing with appropriate qualified people, making sure there's good risk governance in place, applying good monitoring and supervision. They want to have consistent reporting practices as well. Some, like a lot of the issues that ASIC was saying was like, we actually just don't have enough data from people. Some people report really well, some people don't. They want to make sure that there are target market determinations created as well, which is a requirement for regulated lenders to make sure that any high risk or complex fund structures or features are adequately flagged. Again, disclosing all the fees and income streams. This is, again, something that's constantly talked about in private lending. People being slapped with huge fees that they didn't know were coming or hadn't read the terms and conditions properly. Reducing conflicts of interest, having well-documented roles and decision-making within the sort of head office. The valuations, as I said before, making sure that there's clear and consistent methodologies for that. Ensuring liquidity is good, and then also making sure that credit risk assessment and monitoring frameworks are sound. So also stress testing some of their portfolios. So this is what they would like the private lenders to do to really lift their game. Basically been like, if you don't do it, we will come back and we will start regulating you. So I think generally most people are not too annoyed about that. They were like, fair enough.
It's all pretty reasonable requests.
Pretty reasonable, yeah. And I think a lot of the private lenders, particularly the ones that are sort of, doing the right thing, are like, fine, we already do half of these things. We can just tweak our things here and there, so we're not too worried about it. And I think they're also glad that it's just come to a head. Will, you talked to a few brokers about this as well. What did they say?
Well, I guess the first question I asked was, do you think private lending needs more regulation? I think the general feeling is that it's difficult because private lending, you think, it's a balance between the flexibility you get and the speed that you wouldn't get with a major bank, but also ensuring that actually it's, you have all the kind of controls in place. I think generally people said that a bit more regulation would be healthy, but there's going to be a balance in how much. I did speak to one broker and said, do you think it needs more regulation? He was like, well, there isn't any. So I think it's about...
More? He's like, just any.
Yeah, and no one's quite sure. I mean, ASIC didn't explicitly say more regulation, but they basically said more oversight, which could lead to more regulation.
Yeah.
It'd be interesting to see. I thought the report was actually... I thought it was going to be a bit harder. They kind of just...
I did too, to be honest.
Yeah.
I thought they were going to come out and be like, these are all the failings we found, here's what we're going to do. So either they've got great lobbyists in private lending, or maybe they're just not as concerned as, they thought they might be, to not actually have any immediate action. I thought that was interesting, particularly because we have seen them start taking their first steps into action. We saw 2 stop orders put in place for some of the products that were in market. I think those have been remedied already. But they did say, we'll carry on looking at this. We're going to have enhanced surveillance for the next 12 to 18 months. They'll also be talking to federal government on potential reforms to legislative settings for managed investment schemes, not for private lending, and generally just keep engaging with the industry. So we probably will see a bit more coming out from this. But yeah, generally I thought that was a lot of waiting and a lot of to do about not much outcome. But yeah, as you sort of said, ASIC basically saying if they improve industry standards now, it means we won't have to intervene with regulation to force people to do it. So from here, I think we'll see just a few tweaks here and there, but nothing major changing in private lending. This week coming up, it's going to be another busy week. Can't believe we're already in the middle of November, pretty much. And on Friday, we'll be hosting our Women of Finance Summit and Women of Finance Awards here in Sydney, which we're super excited about. Got amazing speakers lined up, including Michelle McPhee from the RBA. We've got two panels actually, of people, women in finance, talking about how they've built their businesses, how they accelerated their careers. We've got Luna Croissantry founder Kate Reed talking about how she shifted gears from F1 to launching her really viral bakery and how she runs a business that has strong brand resonance. And then we're closing off the day with Ronnie Khan from Oz Harvest, who's an amazing speaker, and she's talking about basically building a brand and building a company that gives back, how you can kind of create a company that you actually have strong buy-in emotionally and ethically too. So really looking forward to the Women of Finance Summit 2025, which is taking place on the 14th of November here in Sydney. If you haven't yet bought your ticket, make sure you do, because it will sell out. And then we've got the awards in the evening celebrating some of the leading women in financial services, including in mortgage broking. And we're really looking forward to celebrating with the winners on the day. In the meantime, nice weekend coming up. It's going to be a heat wave here in Sydney. Any plans, Will?
I'm getting married tomorrow.
What?
Yeah. So that's the big one. Yeah.
You have kept that under your hat.
Yeah. It's come around so quickly. It's just the kind of legal bit, doing the ceremony in December. But yeah, so
we're going to talk offline about this.
Okay. Yeah.
And all right, can you top that, Ben? Wow.
No, I'm not getting married. Some bizarre turn of events this evening. But it's my niece's birthday. So shout out to Callie. I don't know if she watches, but she's 3 years old. But
maybe she's going to be a broker and she's starting early.
Yeah. Well, you never know. Yeah.
Well, I haven't got any plans. I'm recovering basically from a lot of travelling recently. I actually was at the FAA conference last week on the Gold Coast as well. So I kind of landed back from Europe, went straight to the Gold Coast, came back, and my body clock was shot. I had no idea what was going on. So I'm looking forward to just having a weekend quietly, resting and recovering from all that travel. We hope you have a fab weekend, and we'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.